Welcome to the Deep Dive. We're your shortcut to getting, well, truly well informed on the big issue.
That's the goal.
And today, we are diving headfirst into something that's got, frankly, everyone on the edge of their seats.
Mm-hmm.
The Federal Reserve's big interest rate decision. It's coming up this Wednesday, September 17th, 2025.
Yeah, the anticipation is definitely high.
So the big question we're trying to unpack is why? Why is the Fed expected to cut rates now? Especially when, we keep hearing such mixed signals from the economy.
Exactly.
We've stacked up insights from Fox Business, Bloomberg, HTPSLR, Investing.com, CNBC, all fresh right around now to help us and you navigate this whole complex picture.
And it is complex.
Yeah.
The FOMC, the Federal Open Market Committee, they're meeting right now. And yeah, the market widely expects a cut.
Right.
But the fascinating part, and what makes this so tough for the Fed, is how the main economic tea leaves are, well, they're pointing in really different directions.
How so?
Well, you've got clear signs the job market's cooling off.
Yeah.
That usually screams cut rates. But at the same time, inflation is just sticking around, stubbornly high. And that normally argues for keeping rates steady, maybe even hiking them.
So they're caught in the middle.
Pretty much. It's like trying to steer a ship with currents,
Huh.
pushing different ways, a real balancing act.
Okay, let's unpack that balancing act. The Fed has this famous dual mandate, right?
Correct.
Two main jobs. Push for maximum employment and keep prices stable specifically. They aim for 2% inflation.
That's the target.
And what our sources are saying this week is that both of these goals, well, they're showing signs of weakness, or at least under a lot of pressure. It's not just one side of the equation.
No, it's both,
Yeah.
which is unusual.
So let's take the employment side first.
Right.
What are we seeing there?
Right. Well, connecting this to the data, it's not just weak, it seems to be getting weaker. August, for instance, only added about 22,000 jobs. That's pretty low.
Yeah, that is low.
But maybe even more telling are the revisions to past months. They went back and looked again. July's number slashed down to 79,000. And June, they revised it so much it actually showed the economy lost 13,000 jobs.
Wow, so it went negative.
It went negative. And if you look even broader, U.S. job growth through March revised down by a massive 911,000 jobs overall.
900,000.
Yeah. Almost 1 million jobs that we thought were there just, poof, vanished from the record. It paints a much gloomier picture of early 2025.
Okay, that's significant.
And it's not just the numbers, sentiment, how people feel, Americans' confidence in finding a new job. It's at a record low since they started tracking that back in 2013.
So people are feeling it too.
Definitely. It all points to a weakening trend, and you can bet the Fed is seeing those same signals. Alarm bells are likely ringing.
Okay, those revisions are, startling. A struggling job market, clearly. But now let's flip the coin. The other mandate, stable prices. Our sources are pretty clear that inflation is, quote, stubbornly high.
That's the phrase you keep hearing.
Despite everything the Fed's done, what do the numbers show there?
Well, their favorite measure, the PCE index personal consumption expenditures. It's actually been trending up, moving away from that 2% target.
Going the wrong way.
Exactly. Headline PCE rose from 2.2% in April up to 2.6% in July. And the core PCE, which strips out food and energy, that went from 2.6% up to 2.9% in the same period.
Okay, so both are climbing.
Both climbing.
Huh?
And the other one people watch, the CPI, Consumer Price Index, that also rose in August, year over year, hit 2.9%. Core CPI was up 3.1%.
So yeah, multiple gauges showing inflation is sticky and, like you said, moving the wrong way.
Precisely. Stubbornly high seems about right.
So this leads to the big question you touched on. What does the Fed do when both parts of their job are under pressure, but kind of pulling them in opposite directions?
It's a dilemma. And
Yeah.
Fed Chair Jerome Powell, he's actually talked about this. He said in these situations, they look at which goal is, quote, further away from target. And then they focus their efforts there. So the thinking is that significant ongoing weakness in the job market, even though inflation is rising, that seems to be the element that's further off course right now.
So the job's weakness wins out, basically.
It appears to be the primary driver, yeah. That's what's underpinning this widespread expectation for a rate cut this week. The job market weakness just seems more urgent, more concerning to them at this moment.
Okay, but here's where it gets, well, really interesting, I think. Because the Fed isn't just looking at numbers in a spreadsheet, right? They operate in the real world.
Political realities.
Exactly. There are these big external pressures. Our sources talk about an intense pressure campaign from the Trump administration pushing hard for the Fed to lower rates.
Yeah, that's been pretty consistent.
The idea being, boost the economy, maybe help with the interest costs on the national debt.
Sure, those are the stated goals.
And adding to that dynamic, President Trump's pick, Stephen Barron, just got confirmed to the Fed's Board of Governors, right in time for this meeting.
Timing is interesting, yeah.
How does that kind of political backdrop affect things, or at least the perception of the Fed's independence?
Well, look, it's a constant tension, isn't it? The Fed values its independence, but it's naive to think they're completely immune to the political environment.
Right.
And that pressure isn't just, tweets or calls for cuts. It's tied up with another huge complicating factor: tariffs.
Ah, yes. The trade situation.
Right. Fed officials have openly debated this. Are President Trump's tariffs going to spark persistent long-term inflation? Or are they just a one-off price shock that'll eventually wash out?
That's a critical
It
distinction.
really is. And Chair Powell himself, he gave a really direct quote on this earlier in the summer. Someone asked him if they would have cut rates more if it weren't for the tariff concerns.
And what did he say?
He said, and I'm quoting here, "I think that's right. In effect, we went on hold when we saw the size of the tariffs, and where essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs."
Wow, so he's directly linking their holding pattern to the tariffs.
Explicitly.
Huh?
It just highlights how trade policy and all the uncertainty around it has directly gummed up the works for monetary policy. It puts them in a very tricky spot.
That is a powerful quote. Really shows the real-world impact. Okay, so given all these signals, all these pressures, how's the market digesting this? What are investors betting on?
Well, as we said, the market has pretty much decided a cut is coming. The CME FedWatch tool, it's usually a good gauge, it's showing like a 96% chance of a 25 basis point cut.
Quarter point?
Quarter point cut, yeah, which would bring the target range down to 4 to 4.25%. There's even a tiny, like 4% chance priced in for a bigger 50 basis point cut.
Okay, so overwhelmingly expecting the smaller cut.
Seems that way. And we saw some immediate market reaction, too. The S&P 500 actually dipped a bit from near record highs when the Fed meeting started on Tuesday.
Interesting. Why?
Well, some of it might just be profit-taking. The classic sell the news concern, the market anticipates something, it happens, and then there's a bit of a pullback anyway.
Right, buy the rumor, sell the facts.
Something like that, yeah.
It's always fascinating to watch the market try and front-run these things. But realistically, is this decision likely to be unanimous inside the Fed? Or are there disagreements?
That's a great question. And no, it's definitely not unanimous, which, adds another layer here. Back in July, in a pretty rare move, two FOMC members, Michelle Bowman and Christopher Waller, they actually dissented.
How so?
They dissented in favor of 25 basis point cuts then, which was significant. It was the first time since way back in 1993 that two Fed officials publicly dissented, arguing for cuts.
So there were already people pushing for cuts back in July.
Exactly. It signals there's internal debate happening even before this week's expected move. It wasn't a lockstep decision even then.
Interesting. And what about other markets? Are they reacting?
Oh, yeah. Gold, for instance. Spot gold surged to new all-time highs on Tuesday.
Really? Why gold?
Well, it's often seen as a safe haven, right? And the anticipation of potentially aggressive rate cuts, lower interest rates, that tends to boost gold prices. People looking for safety.
Makes sense. What about crypto?
Crypto was a bit more subtle. Bitcoin and Ether were kind of flat. But stablecoin deposits, especially USDT, they increased sharply.
Meaning?
It might suggest investors are parking cash, maybe getting ready to buy other assets after the Fed announcement, preparing for opportunities. And we saw altcoin inflows picking up a bit too. So capital seems ready to move.
Okay. And what are the experts, the Fed watchers, saying?
Well, Paul McCulley, former PMCO managing director, he expects that 25 basis point cut, but with what he called a warm and fuzzy tone for future cuts.
Suggesting more coming.
Yeah, hinting at a path maybe towards 100 basis points, a full percentage point of cuts eventually. He thinks a 50-point cut now would signal too much worry about the job market, which Powell probably wants to avoid telegraphing right now.
Manage expectations.
Right. And Seema Shah over at Principal Asset Management, she echoed that, calling 25 basis points appropriate. So the general expert consensus seems to lean towards that more measured quarter-point step for now.
Okay, so market expects a cut. Experts expect a cut driven by all those signals we've talked about. But, for this deep dive, we need to zoom out a bit too. Look at the broader economy, the global stuff.
Absolutely. Context is key.
And our sources point to a really fascinating counter-narrative here. Consumer spending. What's the story there? Because it seems to contradict the jobs picture.
It really does. It's quite the contrast. Despite all those worries about jobs, consumers seem to be, well, spending. U.S. retail sales in August actually rose faster than expected, up 0.6% month-on-month.
Faster than expected.
Yep. Matched July's strong pace, which was also revised upwards, and beat what economists were forecasting.
Where are people spending?
Pretty broad-based, actually. Online sales jumped 2%. Bars and restaurants saw a decent increase, 0.7%. Even gas station receipts were up, though partly due to higher prices. Clothing sales rose 1%, maybe partly because of tariffs pushing prices up a bit.
So the consumer is still strong despite the weak job numbers.
It seems that way. And here's the tension, right? Analysts at Vital Knowledge pointed this out. Normally, that kind of healthy spending might make the Fed think twice, maybe lean a bit hawkish, maybe hold off on cuts.
Right, because it suggests the economy isn't really faltering that badly.
Exactly. But Vital Knowledge also emphasizes that, quote, the Fed is focused on jobs. So the suggestion is even this strong consumer spending isn't necessarily enough to deter the Fed from acting on its primary worry right now, which is the labor market.
So it's like, yes, spending is good, but the job situation is worrying us more.
That seems to be the calculation they're making. It's a genuine dilemma for them, adds another real wrinkle.
Okay, so that domestic resilience adds complexity. But the Fed's world isn't just domestic, is it? They have to factor in the global scene, too. International trade, geopolitics. And our sources flag a big ongoing story, U.S.-China relations, and, yes, TikTok.
The TikTok saga continues.
Indeed. What's the latest there, and how does that fit into this whole economic puzzle?
Well, there was actually a fair bit of optimism coming out of the U.S.-China trade talks in Madrid. President Trump himself posted quite positively on social media. Said the big trade meeting has gone very well.
Okay, positive noises.
And he even announced a framework deal for TikTok's U.S. ownership, which is huge, given that September 17th deadline was looming for ByteDance to sell its U.S. operations or face a shutdown.
Right, that deadline is literally tomorrow.
Exactly. And Treasury Secretary Scott Bessent, he gave some insight. He said President Trump's willingness to actually, quote, let TikTok go dark was what turned the tide in getting that framework agreement.
A bit of brinkmanship paying off, perhaps.
It seems that way. And you saw Oracle's stock jump, right? Reports confirm they're part of a group of firms helping set up TikTok's U.S. operations.
So what does this mean for the Fed? Does a potential TikTok deal ease some pressure?
Potentially, yes. A resolution there and positive trade talk generally could reduce some of that uncertainty, some of that risk premium the Fed has been wrestling with due to trade tensions. A bit of relief, maybe?
Okay, so a framework deal for TikTok, positive trade talk, at least for the moment. But beyond the U.S.-China dance, are there other global currents the Fed's probably keeping an eye on, even if they aren't the main driver this week?
Oh, absolutely. These things form the background noise, the constant uncertainty the Fed has to consider for its longer-term view, even if they don't dictate this specific decision.
Like what?
Well, for instance, there's still talk about those reciprocal tariffs on India and China, potentially up to 100% if the EU doesn't also act against Russia.
Yeah.
Those are supposed to kick in this November.
So more tariff uncertainty down the road.
Exactly. Treasury Secretary Bessent expects more talks,
Yeah.
but it's still out there. Then you had that temporary spike in oil prices recently. U.S. crude hit $63. Brent hit $67 after those Israeli attacks in Qatar.
Right, a reminder of geopolitical risk.
Precisely. An expert, Karen Young, suggested the price rise might not last unless oil facilities were directly hit. But it shows how fast geopolitics can ripple into markets.
Sure.
And just look across the globe. Asian markets were actually rising leading into the Fed meeting, partly on expectations of U.S. rate cuts. The MSCI Asia-Pacific Index was up for 5 days straight.
So Fed actions, even anticipated ones, have immediate global effects.
Absolutely. It just underlines how interconnected everything is. The Fed acts or is expected to act, and the waves spread everywhere. It's this incredibly complex web they're navigating.
Okay, let's try and pull all these threads together then. What's the big picture takeaway here? We've got the Fed doing this really intricate dance, balancing this weakening job market against inflation that just won't quit, all while dealing with intense political pressure, these terrible complications.
And that strong consumer spending just adding another layer.
Exactly. It feels like they're playing, I don't know, 3D chess with the economy right now.
It really highlights how all these pieces, domestic and global, are linked. And while that 25 basis point cut seems like the consensus, the deeper story is why. It looks like the Fed is choosing to prioritize the job slowdown, even with inflation high and consumer spending.
Right.
The full effects of the tariffs, the trade talks, geopolitics, that all continues to shape the outlook way beyond just this one announcement. It feels like a moment of maybe significant recalibration for them.
Which leaves us, and you, with a final provocative thought to chew on. Considering all these pressures, if the Fed is cutting rates mostly because the job market is weak, what happens if consumers just keep spending like they are now?
Mm.
And what if inflation stays sticky because of things like tariffs, these external factors? What could those unintended consequences be?
Yeah, what does that scenario mean for economic stability down the road?
And how might the Fed be forced to react later if these conflicting signals just keep playing out? It's a deep question, and honestly, the answer will probably shape the financial world for months, maybe even years ahead.